Let's bring in E.J. Antoni, Heritage Foundation Chief Economist, and Doug Holtz-Eakin, American Action Forum President and former CBO Director. Gentlemen, great to see you. Thanks for coming in.
Thank you.
Doug, first to you. We got these structural changes that he wants to do, really fundamental changes, lowering the balance sheet, but even more than that, changing the sort of intellectual perspective of the Fed, which has been basically anti-growth in a lot of people's minds. But immediate concerns are the rates. And we got a Fed meeting coming up in mid-June, about 3 weeks from now. What do you think is going to happen? I mean, with inflation kind of spilling over into the core rate beyond just energy, is there any chance he might raise rates?
I think in the absence of something really dramatic on the upside, they're not going to raise rates. They'll hold rates steady at his first meeting, but we will see some changes in how they talk about it. He's been fairly critical of the forward guidance part of the Fed communication, so I expect the statement to look very different. I don't know how often he's going to talk to the press and do press conferences. He thinks the Fed talks a little bit too much at the moment. So I think we'll see the first change will be in how the Fed talks about what it does, and then the real changes come at the second meeting. And we'll see what he does on balance sheet rates and things like, you know, the outlook. How does he really think about how the economy is doing? We have a little bit to learn about how he thinks right now.
EJ, I remember, since Alan Greenspan's his mentor, one of his mentors, I remember how short he was in answering questions. If he'd even get to a press conference, he'd be very taciturn, to use a high-quality word there, about not saying hardly anything. And even when he did talk, it was kind of in riddles. Is that what we're going to get from Kevin Warsh?
Yes, he was unambiguously opaque in the way he responded to reporters. Absolutely. I'm not sure that is necessarily the primary lesson that Kevin Warsh took away from the Greenspan era. I think it was more so this. Under Greenspan, markets typically knew how the Fed was going to react to economic data, and markets moved before the Fed even did. And oftentimes, I think you could have made the argument that the Fed didn't need to act because the market moved for it. The reason for that was because, unlike Jerome Powell, the market, or excuse me, I should say the Fed, under Greenspan was very, very data dependent. And so as inflation ticked up, the market anticipated the Fed was going to go into a tightening cycle. As inflation cooled, they anticipated the Fed would do the opposite. So I do think we're going to see more of a return to that with Warsh. And as you were saying, it's going to be, I think, a complete reorientation of the Fed out of these failed Keynesian models and back to traditional economics.
You know, the good thing about his various positions, Doug, is that on the one hand, he's a supply sider, and he does believe he's not afraid of growth, as a lot of people at the Fed are. Those people stuck in the old Phillips curve, thinking that if you have growth, you're necessarily going to have more inflation. Well, we saw that didn't happen with Ronald Reagan, didn't happen with Trump's first term. So that's not true. And yet you have 300 economists at the Fed saying it still is. Is he going to be able to turn around that mindset?
I don't know how much he'll change people's thinking, but he's going to change what the Fed does, and he's going to change what markets think of the Fed's actions. And whether people inside the building are on board or not, we'll never know. He has a management task of the first order. I mean, he has to go in there and go to a place where he has worked before. But now when you're the boss, it's a little bit different. He's going to have to set that tone, get the Fed doing things that EJ talked about in terms of setting market expectations. I think that's really important. And they have to reestablish some credibility. I mean, let's be frank. It has been 5 years since they were at the inflation target. It's time to get there. I mean, so that's his
and their
job.
predictions about the economy were all wrong too. I mean, they were going in exactly the opposite direction about the way things turned out. So they've just got a bad track record.
It's you know, it's the challenge that he inherits. But all of these handoffs are a fresh start. That's true for Mr. Warsh. It's also true for the Fed. And so they have to get their collective thinking straightened out and get to business.
EJ, one thing about Donald Trump as a former real estate guy is he hates high interest rates. One thing about Kevin Warsh that we know is he believes in a strong dollar. Sometimes those beliefs are at ends with each other, cross ends with each other. What happens? I mean, Kevin Warsh, just to put it simply, he believes that the dollar somebody earns today should be worth the same a year from today, or close to it, so that people don't lose the wealth that they have obtained in the marketplace, or even if they're on a regular fixed salary. So how do you square that with Donald Trump's desire to get interest rates down?
Well, David, one of the things that I think Kevin Warsh really understands very well is the fact that the Fed has several different tools in the toolkit, and it's not just the Fed funds rate, the interest rate that we always talk about, the Fed putting up, putting down, leaving unchanged. And if we look back to 2024 in the fall, towards the end of the year, what happened? The Fed essentially cut 100 basis points, but what happened to real-world interest rates? They didn't go down, they went up, and they went up 100 basis points. So if markets are just anticipating that the Fed is, in that case for political purposes, cutting their key interest rate and they're going to spark more inflation, what does the bond market do? They demand a higher yield. They demand a higher return to compensate for that lost value in the dollar. And again, these are all things that I think Kevin Warsh understands very, very well. It goes back to this idea of shrinking the balance sheet, reduces that inflationary pressure, and then provides the market room for interest rates to fall. Again, it's not just a matter of the Fed, I think, has to twist the market's arm and try to get those interest rates down. They will come down naturally as those inflationary concerns evaporate.
But the problem, Doug, and I'm thinking in particular about the mortgage rates right now, which are 6.5% for a 30-year fixed mortgage. The Fed has about $2 trillion of mortgage-backed securities. If they sell off those mortgage-backed securities in order to get buyers for that $2 trillion worth of MBSs, doesn't that mean that mortgage rates, there's a pressure to have higher rates in order to be able to sell them off?
Well, I think you've put your finger on the problem, and the solution is to do it very slowly. And the Fed was, in fact, doing that. It was running off the balance sheet, and it chose to stop and then actually reverse. I think that's the mystery, and I think that's what he'd like to take on. Why not just continue to run off the balance sheet, get it down to an appropriate size? You don't have to do it all in a month or all in a year, but you do have to keep setting the expectation that the balance sheet they want is much, much smaller. Market will react appropriately.
EJ, the last point is that we still have these wonderful incentives in the economy. First of all, the president on his own, as we saw yesterday with the refrigeration deregulations, he can deregulate the economy, which had been terribly overregulated during the Biden years. And he's begun to do that in a dramatic form. It's having an effect, making the country more productive, giving a boost up, particularly the smaller businesses, which are so important. So the supply side incentives are still there. And of course, those tax cuts are already beginning to have tremendous impact on growth in America. So that's going to help Kevin Warsh, isn't it?
Oh, certainly, David. That is a tremendous positive effect in terms of supply-side economics here. And look, going back to the first Trump administration, when deregulation was, I think, really the unsung hero and did even more for the economy than the original Tax Cuts and Jobs Act, this go-around, I think it's the exact same playbook. Deregulation is actually, in my opinion, doing far more good than the one big, beautiful bill. This administration has cut over 120 rules for every new one they've implemented. I mean, that is doing absolute wonders for getting rid, I should say, of all this government red tape, getting it out of the way for innovators, for inventors, for consumers, businesses,
and for energy, for our energy boom. I mean, which we need. We understand now more than ever that we need the drill, baby, drill, and those deregulations have helped that. Gentlemen, we've got to leave it at that. Have a wonderful Memorial Day weekend. We appreciate you coming in, EJ Antoni and Doug Holtz-Eakin. Appreciate it, guys.
Thank you.